Hey, everybody. Jeffrey Beamer here, Senior Investment Strategist over at ewotrader.com, and welcome back to Earnings Call. We are kicking off the next quarter of earnings. This is earnings season. We are getting back into it. We got some big names, okay? Not a whole lot of earnings, but the earnings we do have, a lot of big names, including Goldman Sachs, JPMorgan, Bank of America, Wells Fargo, and then some non-banks like Netflix and PepsiCo, all declaring earnings this week. This is a significant week because of all the banks, all the big banks. And then we get into medium-sized banks and then the regional banks in the following weeks. But the big headliners this week are all the big names. And we're going to get into it starting right now. All right. If you don't know what we do here, we talk about earnings. Okay. I'm not so concerned with how the market's doing. Is it going up? Is it going down? We're focused on stocks that declare earnings for this week and their relationship to movement and the options that are traded around the stock. We break our list into stocks that have little expected movement. We call those quiet stocks. They're on the right-hand side of this page that you're seeing. And then those that are more volatile or expected to be more volatile, they appear on the left-hand side. And we call these breakout stocks. Now, there's something very interesting that's very different this week than we've ever done before. And I'm going to show you when we get to the breakout stocks. So stay tuned. All right. But we're going to start off with the quiet stocks because that is what our focus is on this week. Okay. It's on these quiet stocks. What does a quiet stock look like? Well, this is a chart of Pfizer. Now, Pfizer does not declare earnings this week, but this is just a great example of a stock that's stuck in a range. It's really not doing anything. And during earnings, it moves less than 3 or 4%. Okay, single digit moves. That's what Pfizer does, period. Okay, so that's a good example. So if we go over to our list, you're going to see that we have all the big banks. We got Goldman, which declared today. We're going to take a look at that in just a moment. We have JPMorgan and Chase. We have Citibank, Morgan Stanley, Bank of America. What's missing here as well is Fargo, and I'll tell you why in just a little bit. But we have some non-earnings like PepsiCo, we do have earnings, but non-banks like PepsiCo and Progressive, which is actually insurance, and Travelers, which is insurance. Okay, so let's take a look at the chart and we'll talk about these stocks. Okay, now Goldman actually declared this morning. Okay, the expected move here, as you can see, was 4%. Okay, that is the average expected move for Goldman. And what did Goldman do today? Well, as you can see here, it's down 2%. It gapped down a little bit lower, but it has rallied up. And we're not so concerned about the movement during the day. We're concerned about the close. Okay. And what we like to do here is that when we get close to earnings, implied volatility on options, it's called an explosion. I mean, it rises big time. All right. And we sell that expensive IB, okay, because that directly affects the option prices. We sell those expensive prices. And then once the announcement comes, implied volatility drops. And that is how we profit because we sell high, buy low, profit. Okay. So Goldman, man, beautiful stock to trade, even though it is a $900 stock. Okay. It's one of the few $900 stocks that we do look at for this kind of strategy, whether breakout or quiet stocks. But so Goldman had earnings today. And as you can see, the average expected move is 4%. It moved less than that, which is perfect for our strategy, which we usually sell iron condors. We don't just sell naked options. We don't do that at all. We always use a vertical spread where we sell the spread on top, meaning a call spread, and sell the spread on the bottom, which is a put spread. Combine those together. That's called an iron condor. All right. So let's go through the list. Now, here is something that we don't like to see. Okay. This is Fastenal. They declared this morning as well. Their average expected move was 5%. But look at this. The stock currently, as we talk, is down 7%. It's down 7.25%. So it's actually exceeding its expected move. That is part of the risk that we often see in iron condors. And you're going to actually see another example of that a little later on. So you're going to want to stay tuned for this because it really does affect us. All right. But let's continue on. Johnson & Johnson, they have earnings coming up tomorrow before market open. Now, one thing you'll notice from this list on quiet stocks, they all declare in the morning before market open. Even Johnson & Johnson here, the average expected move is 4%, okay? It doesn't move very much. You can see the last earnings cycle back here in January. Stock gap down, rallied higher, and it closed higher by not even 1%. Okay. That is the type of action that we expect from a stock like this. At $235, this is an ideal stock for an iron condor. Anything really from $50 for a low to $400 as a high, with the exception of a stock like Goldman Sachs, okay, is where our sweet spot is. So Johnson & Johnson, look for that tomorrow morning. And the reason is these are just such big companies. It takes a lot to move the needle when it comes to these companies. Excuse me. All right. So JPMorgan, they declare tomorrow morning as well. Tuesday, April 14th, before market open. And again, the average move here is just 3%. You can see that JPMorgan gapped higher 3 days ago. Okay. But that was not earnings related. And even with that gap, it wasn't a huge double-digit percent. And this is a notorious quiet mover through earnings. We love, and at $311, we love trading iron condors on these banks like JPMorgan. Okay, so continuing to move on, we have Citigroup. Citigroup is going to look the same. You have that gap higher from a couple of days ago. Their earnings here for Citigroup they will declare tomorrow. April 14th. That would be a 4. Okay. 414 before market open. The average move there is plus or minus 5%. And at $125, again, right in our wheelhouse. Love that pricing on Citigroup. Okay. Now, continuing on with the bank theme here, we have earnings for Morgan Stanley coming out on Wednesday, April 15th, before market open. And let's rinse and repeat at $180, right in our wheelhouse for an iron condor. The average move here is 4%, so it's under 5%. So if I can get my break evens on that iron condor, let's say 6-7% away, and the average move is only 4%. So the stock then stays between my break evens, where it had to rise 7% or more to suffer a loss, or decline 7% or more to experience a loss. When the average move is only 4%, that is ideal. We love that setup on Morgan Stanley as well. Now, at the lower end of our range is Bank of America, but the same thing here. This is a bank, a big bank, as a matter of fact. They will have earnings on Wednesday, April 15th, before market open. So Tuesday and Wednesday are going to be days to watch. In fact, this whole week is really a week to watch outside of earnings, okay? But when you add earnings into the mix, okay, it could be a volatile week, or we could actually go nowhere, okay? For example, just today, market's up, S&P's up 45 basis points today. It's up just a little bit, all right? And you can see some red and green across the board on my list over here. But Bank of America, its average move is about 3% through earnings, okay? As you can see, even though it gapped down on its last earnings announcement on Bank of America, that move wasn't very much, okay? That move was 3.78% right here. 3.78% was that move, which is kind of right in line with a plus or minus around 3% for Bank of America. Now, still financial related, okay, would be Progressive. They will declare Wednesday, April 15th, before market open, and the average move here is 4%. Okay, now that's average. Sometimes it'll move more, sometimes it'll move less. We get to an average, and that's where a stock being $200 a share, that is ideal. Their last earnings announcement, it wasn't this gap back here. Their last earnings announcement was actually January 28th, which was right, boom, right there. There was their last earnings announcement right here on this date right here. It was not this gap. Okay. So you can see not much movement from Progressive. Okay. Its average move is about 4%. Okay. Now, another good mover, this is one we often do trade, is PepsiCo, big company. Okay. $155 price share, per share price. They will declare on Thursday, April 16th, before market open. And the average move here is about 5%. So you can kind of see a theme here developing between these big conglomerate companies, banks especially, but then you have some non-banks as well, that just don't move very much, and they are perfect for an earnings strategy, specifically selling premium around earnings. All right, Bank of New York Mellon, they will declare Thursday, April 16th, before market open. The average move here is just 3%. Their last earnings back in January, look at that. So right in the middle of this little trend here, just an average day, up a couple of percentage points, maybe 1.5% on that. No big deal. All right, ideal at $128. Love that for a potential iron condor as well. Gives us a lot of strikes to choose from. Wait for that implied volatility rush. That's what we like. Now, travelers. Travelers will declare on Thursday, April 16th, before market open. How about that? All of these before market open. The average move here is about 5%. And you can just see last earnings cycle, well within 5% on that move back in January. I'm not worried about the trend up or down, or the fact that we made a higher low here. The stock is definitely in a longer term uptrend, as you can see, but just not a big mover through the earnings cycle. All right. And our last stock within the quiet stock complex for right now is going to be State Street. And they declare on Friday morning, April 17th, before market open. And the average move here, even though this is on quite the little trend here, this is almost an ideal setup because we use short-term options, meaning options that expire in a very short period of time. This might be a very nice trade at $140 a share. We will be definitely looking for an opportunity on State Street as the week goes on, and to sell an iron condor and expect a move in that 4% range for State Street. So once again, these big companies, imagine doing 2 or 3 of these and having success just because these stocks don't move very much. That can actually generate several percentage points on portfolio just in a week. Okay. Very conservative strategy, and high probability of success when you put the odds on your side. All right. So that is our quiet list for this week. Now we're going to talk about those crazy stocks, breakout stocks. All right. Everybody loves the breakout candidates, but here's something I've done this week that's a little bit unique. Okay. You ready? Let's take a look at an example. Okay. Before I get to the good stuff, Akamai. Now, Akamai does not have earnings this week, but this is an example of a stock that really moves through the earnings. I have the earnings all highlighted with the ellipse, as you can see. This stock is a big mover, always double digits, great stock to trade, except for these stocks, we use straddles and strangles. Yes, implied volatility is a little higher, but straddles and strangles, when we can get them for the right price and experience a double-digit move, is the way to go, okay? Because we don't have a range for that stock to break out or to stay within. We want that stock to move. And Akamai, it's a mover, okay? So that is an example. But here's the thing. I came up with a group of stocks this week that are on our breakout list that may not break out. And this is we're going to go through all four of these stocks and you're going to see something very interesting. Okay. We're going to start with CarMax. Now, here's the thing on CarMax. All right. Take a look at this. They are going to declare Tuesday, April 14th, before market open. The average move for CarMax is about 9%. Okay. But right now, options are pricing in a move of 11%. Now, this is what I like. Okay. CarMax is I'll tell you right now, CarMax is the only breakout stock that I probably like for this week. However, it's a big risk because I need to get my straddle or strangle priced under for like an 7 or 8% move. Okay. Unfortunately, the options, if the expected move is 11%, that's what the market makers are pricing in. So here's the thing. If I price my straddle or strangle and it's going to take an 11% move to the upside to make money or an 11% move to the downside to make money because I'm buying a call and a put. Okay. Buying a call and a put at the same strike, that's a straddle. Buying a call and a put at two different strike prices, that's a strangle. If the options market makers are pricing this in at 11%, but the stock only moves 9%, that's a loss. That's a potential loss. All right. You see last time, look at this. Last time it barely moved. It did not move. CarMax did not move at all. But you go prior to that, look at this, a nice little gap. Okay. And straddle or strangle would have worked, but it would not have worked back here. So in reality, CarMax is about a 50-50 stock, and I would definitely look for pricing well under 10% with market makers expecting a move of about 11%. Okay. The fact that it did not move much the last time, this time it possibly could. All right. Now let's look at trucking. JB Hunt. All right. They are going to have earnings on Wednesday, April 15th, after market close. But look at this. The expected move is 10%. The average move is 7%. Okay. So market makers are pricing in moves greater than the average move right now. So they're expecting some volatility, but that's pretty risky. Okay. That's why you always want to check that option pricing right now. If I had an average move, if this was opposite, if I had an average move of 10% and options, the expected move, meaning the current option pricing was pricing in 7.8, that would be a great deal. And we do see those from time to time. Okay. Where the option pricing is currently at, say 9%, but the stock historically moves 16%. Okay. That means there's some mispricing and we can take advantage of that and we can make money. And yes, it does happen. And it happens on a regular basis. Okay. Moving on, we have Alcoa. Alcoa declares on Thursday, April 16th, after market close. On Thursday, the expected move here is 13%, but the average move is only 4%. This is telling me, what this is telling me right here is this: I need to watch this. I don't want to trade it. I want to watch it, because if Alcoa starts getting more volatile, that will make a big change. You can see the volatility kind of increasing here just on the chart that we've seen. Notice how the volatility for Alcoa has increased compared to what it looked like prior. All right. So again, this is one of those things where, man, I would have to get a trade off really cheap, a straddle or strangle for, expecting a 5% move or a 6% move just to reduce my risk. All right. Because they're expecting a 13% move. I'd be very careful with Alcoa when we see these numbers this far apart in this way. Again, if my expected move was 4%, but the average move was 13%, if these numbers were reversed, I'm all over it. I'm all over it. Great opportunity. And we're going to close out our list this week with Netflix. Netflix, believe it or not, has had some volatility here recently because of their on and off deal in acquiring Warner Brothers. Okay, they're going to declare Thursday, April 16th, after market close. But look at this: the average move is just 6.3%, but the option market makers are pricing in a move of 11%. Okay, so something's up, and I think they're looking at that deal off deal, and now looking at the pure bottom line of Netflix and their number of subscribers and their revenue, and they're pricing in a little bit more volatility this time. So again, another one to watch. It would be very difficult to trade this when the stock average is about 6%. Okay, if it doesn't move, if it only moves single digits, it'll probably be the next earnings cycle. Okay, that'll be August. May, June, July, August. Yeah. April, May, June, July. Probably into July, somewhere into July. I would definitely look at an iron condor on this if it does not move that double digits. If it does move double digits, Netflix may be back on our breakout list. Okay. But I just wanted to give you these examples of what we run into when we're pricing out all these stocks and their average move and their expectations. Okay. So I'd be very cautious with trading any breakout stocks this week. It's all about the quiet stocks and the big banks and the insurance companies, just their lack of movement. Goldman moving 3% today, right in line with what we normally see. Fastenal, it's not a bank, it's not an insurance company. So the fact that it moved over 7% is just not not surprising. It's not anything out in the ordinary other than noted. I noted that this moved. It's on my quiet list, but it moved more than the expected move. And the day's not over yet. Okay, I'm more worried about the closing price. That closing price is the most important price of the day. Okay, so just reviewing our list one more time. You see the big names. Oh, I did mention that Wells Fargo. Wells Fargo is just not pricing in right now. It's again, it's an $85 stock. Wells Fargo is, and I could have put them on there, but I wanted to put another company on there. You could watch Wells Fargo as well. Being an $80 stock, it does kind of qualify for our strategy. In fact, a note there on Wells Fargo, the expected move is 4% right now, and the average move is 3%. So the expected move is 4.5%, and the average move is 3.8%. So it's kind of right in line. So there's a little bonus one for you. Okay. All right. So with that, then let's take a look at our trade from last week. Okay. We give out a trade each and every week. So we start with last week's trade, and then we will go to a trade for this week. This was an iron condor on Constellation brands. And I like the width here, okay, of the opportunity. What we don't want is a big move. Okay. What we don't want is a big move on the stock. And this was, the expected move. You can see the last earnings event indicated with the E there back in January or whenever that was. And stock just didn't move very much. Well, let's see how we did on it. Information came out, and we got that big green candle. The stock, it moved higher by 8%. And we had our break evens right at 7% away. Okay, 7% higher and 7% lower. It just needed to stay within that width. And this stock moved up. Now, during the day, it came way down. It came down from near this closing price of 8%. It came all the way back down to about up 5%. That's when we exited the trade. We sent out a trade alert to our subscribers. Okay. We will make this available to the public in a few weeks or maybe a month or two. Got a new publication coming out where we do these each and every week off of trades that we do here on this show. Okay. So you can see here it was trade ID 2015. And with that, you get the strike prices, you get the expiration date, all those things. You get updates and commentary from me if necessary. But here, the stock gapped up. we exited on the call side only. The puts we let expire worthless, which helped reduce cost. And then we exited the calls for a net loss of $1.35 per iron condor. Okay. Which not bad, because it could have been a lot worse, especially if you waited a day till Friday, which is that second green bar. And then you probably lost close to your max risk in the trade, which here was $5. Your max risk was $5 per spread, or for the iron condor, minus your credit, which we got $1.30 on this. So your max risk was $370. Okay, your max, the worst you could do is lose $370 per spread, and we lost 135 of it. Okay. All right. So what are we working with this week? So here we come to the part of our show where we talk about this week's trade. And even with all the banks, I went with an insurance company on this, and we're going to look at Progressive. Okay. We are going to look at this company here of staying within its expected move here for Progressive. We're doing an iron condor on it, and they will declare, as you saw, they will declare on Wednesday, I believe it was. Wednesday, yes, before market open. All right. So this is what the iron condor looks like. It's got an upper break even, which is that dotted line up above price, and then the dotted line below price that goes from the risk graph over to the chart. That is the lower break even, and we just want this stock to stay right in the middle there somewhere. So we just wanted to move it. We want this stock to move no more than really 3 or 4%, and we'll be good. We'll be good with this particular trade. So it's an iron condor on Progressive, and we will come back to you next week right here on Earnings Call to talk about this trade. And the number of earnings next week, it really starts to get cooking, because we have a lot more companies declaring next week. So we will have another full list of quiet stocks, and also a lot more breakout candidates coming up as we get into the next quarter of earnings season. That's our trade for today. That's our show for today. So everyone have a great trading week, and I will see you again next Monday. Take care.